Hi, welcome to ArkIntel. Something big just happened in the US economy, and it could be the calm before the storm. The yield curve, one of the most reliable signals of economic trouble, has just shifted out of its inverted state. Yes, you heard it right. The yield curve in the United States uninverted in the month of August. This means that the yield curve went back from being below zero, which is called an inversion, into positive territory. Now, this might sound all technical, but actually, it's pretty logical and straightforward. History shows us that every time the signal changes, a crisis is about to follow. Could we be on the brink of another major downturn? Or has this crisis already begun? Stay with us as we uncover what this could mean for you, me, the US economy, and the world economy at large. The yield curve, a warning from history. Let's first understand what exactly is a yield curve. A yield curve is a graphical representation of the relationship between interest rates and time of maturity for bonds of equal credit quality. It shows how the yields on bonds change as their maturity dates approach. The shape of the yield curve can provide insights into the current economic conditions and especially the future market expectations. So, for example, a normal yield curve is upward sloping, meaning longer-term bonds have higher interest rates than shorter-term bonds. This behavior is typically seen in a growing economy, as this shows that investors have faith in the long-term growth of the US economy. On the other hand, a flat yield curve is horizontal, meaning interest rates are relatively equal across different maturities. Then comes the inverted yield curve. An inverted yield curve is downward sloping, meaning short-term bonds have higher interest rates than long-term bonds. This is often seen as a sign of a potential recession just waiting to happen. But why does the yield curve have this almost supernatural ability to predict disaster? It's not just a line on a chart, It's a window into the collective fear and expectations of the financial world. When the curve inverts, it signals panic. Short-term rates suddenly go higher than the long-term ones. The markets are screaming that the economy is overheating, and the Federal Reserve starts slamming on the brakes by raising interest rates. But when the curve shifts back, it's a sign that something even worse could be unfolding. It means the economy is cooling down rapidly, unemployment is starting to rise, and a recession, which was lurking just around the corner, is finally here. What's happening now isn't just a coincidence. History shows us that the yield curve inverts for a long time and then uninverts just before every major economic meltdown. Remember the month of May of 2007? Just months after the inversion and then uninversion, the global financial crisis struck, which was one of the worst financial recessions in recent years, something many countries have not yet recovered from. In the month of November of 2000, the yield curve flipped back, and soon after, the 2001 recession hit hard. Even in the month of October 1929, right before the Great Depression, the yield curve was right there, quietly predicting the chaos that would change everything. Every single time, it was the yield curve that sounded the alarm before a financial crisis. And here we are once again. The yield curve just went uninverted after being inverted for 700 days, the longest stretch since the Great Depression. History has also shown us that the longer the inversion, the deeper the recession, and more brutal the market crash afterwards. Think of 1974, 2008, 1929. Those weren't just dips, they were economic earthquakes. Each time, the stock market dipped by over 50%. If history is about to repeat itself, we could be facing one of the most severe downturns in decades. And we've already started seeing the first signs of trouble. The unemployment rate in the US is on the rise. The Institute for Supply Management Manufacturing Index reported its fifth straight month in negative territory, signaling that the manufacturing sector has been in a deep slump for a long time. ADP data showed that 99,000 jobs were added in August. That was a drop compared to 111,000 jobs added in July, pointing to a slowdown in hiring. It was the slowest monthly job growth seen since early 2021. The layoffs that have been mostly restricted to tech have now started to spread across other sectors as well. We are now also hearing that the Fed is expected to cut interest rates aggressively. Is the aggression because the Fed is panicked and knows that a recession is now inevitable? The signs are everywhere if you can see them. Are we on a path to recovery, or are we teetering on the edge of a cliff, about to plunge into a deep recession? The yield curve isn't just whispering, it's screaming a warning. We at ArkIntel have been saying this for a long time and have made several videos warning you about this. Remember this tweet dated back in March 2023? The only question is, have you been paying attention?